Please welcome Terry Roach, Tab Group, Emmanuel Adu, Credit Suisse, Adam Krellenstein, Symbiont, Robert Palatnik, DTCC, and Frederick Voss, NASDAQ.
Okay. Good morning, everyone. My name is Terry Roche. I am head of FinTech Research at Tab Group, and it's a pleasure to be here moderating this panel this morning. I'll ask my good colleagues to go ahead and introduce yourselves, please.
Hi, my name is Emmanuel Adu. I'm at Credit Suisse, and I look after the blockchain and distributed ledger group there.
Hi, my name is Adam Krellenstein. I'm the CTO and one of the co-founders of Symbiont.
Hi, I'm Rob Palatnik. I'm a chief architect, and I run IT strategy and architecture for DTCC.
And I'm Frederick Voss. I lead NASDAQ's blockchain innovation initiative.
Okay, thank you, gentlemen. So this panel is starting off with a headline of speed and security settlement, and I think that most of us here on the panel would agree that the speed of settlement is not a technological issue. Rob, I wonder if you could kick us off and address what your view is on speed of settlement from DTCC's technology standpoint.
Sure. I guess we look at speed of settlement, and as we've been looking at blockchain, it all goes to where is the most friction and where's the pain. I know there's a lot of discussion around equity clearance because that sounds, I guess, after cash, people have stocks, and it sounds like a simple use case. But the reality of today's markets is we receive over 100 million trades a day from over 50 different marketplaces. Those are all received within a millisecond, up to a second after trade execution. The average cost for to clear one of those trades is under a penny. Those are all processed in real time. The validations are sent back in real time. We have a real-time settlement system that actually runs a few microns of silicon next to that settlement, next to that trade receiving system and trade validation system, and that also runs in real time. So the technology distance between real-time execution of a trade and real-time settlement is literally a few microns of silicon, but a few decades of practice is what makes it a 3-day settlement cycle. That's regulations, that's market practice, that's investment brokers doing large blocks and allocating them to investment funds, that's retail clients writing checks, and that's regulations to protect the investing public. So we don't see that, as Peter Thiel puts it, that 0 to 1 huge efficiency gain of cost reduction when you already have an average cost of under a penny for a cleared trade. But then we look at some other asset classes, and those were referred to in some earlier sessions, that take weeks, months, 60 days, 90 days to settle, to get multiple parties to agree on a contract. Those are huge opportunities and huge areas where getting multiple parties to agree on a contract can reduce the time of settlement dramatically. And that's really where we see speed of settlement applying.
All right, Rob, thank you for that. I think for the balance of the session, the abstract for this session reads, blockchain innovators envision a world without third parties, but do banks, clearinghouses, and other third parties still have a role to play in global finance? So I don't know that anyone on the panel is envisioning the demise of the financial services cartel globally, and the market makers have owned the market infrastructure throughout its history, and probably for some good reasons and certainly to their advantage. I think that we're seeing potentially a world where due to the regulatory obligations around know your customer, AML, et cetera, that I think many for capital markets envision a blockchain for cap markets to be more of a walled garden, a closed environment. Frederick, what's your view on that?
I mean, with the new technology comes opportunities, perhaps. Remains to be proven, of course. I mean, it'll has the potential to challenge certain existing business models. I mean, for some asset classes, remains to see which. Of course, if your business model is dependent upon an extended period of time between execution and settlement of the trade, may not be viable going forward or less viable. If your only job is to update the ledger as a trusted third party, you may be challenged by that. But there is a lot of other stuff going on that these entities provide, and a lot of that doesn't go away. just because we have a new technology, because they are driven by other needs. Some are regulatory, but some are actually needs by the individuals or the participants in that market.
I never disagree with Frederick. Too smart to do that. But I would say that, if you've got a lopsided revenue model that is heavily based on some of the, let's call it low-hanging fruit, and not to disparage anyone in the room who works in an institution that I'm going to call it the SubBasement. It's no secret that blockchains, Bitcoin, things like that of that nature are targeting things like remittances, transfer banking, correspondence banking. Let's just, for the sake of argument, call that the SubBasement of financial services. Well, then the basement might be things like custody services, asset servicing, that type of stuff. So I think if you have a business that is largely modeled or gets a lot of revenue from those types of activities, and you might want to rethink it.
Yep,
and I think you were saying the same thing, but I want to make sure people don't walk away thinking everything is a walled garden and that everything's secure. The technology will have fundamentally change, I think, some of the players that have been around for over 100 years.
Adam, you wanted to?
Yeah, I guess I wanted to say that more philosophically, a lot of problems that don't look like technological problems initially end up being solved by technological problems. And I thought of the Henry Ford quote, where if he said that if he'd asked his customers what they wanted, they'd have said a faster horse. And it turns out that there was a technological solution to that problem, even though it didn't look like it. It looked like it was a problem of just getting faster horses wherever they might be and feeding them more hay. But this is of course a cliche, but the technology really is disruptive. It breaks a lot of fundamental assumptions about how computer systems work, what the network architecture is like, and in doing so, it can radically change the workflows themselves in such a way that actually enables greater change than I think would initially be envisioned.
Ready?
Yeah, but the original question was, does this sort of technology, it was a question about speed, that is what I was going to, and I mean that speed question, the current technology already addressed. I mean, Nasdaq main business is actually the technology supplier. We supply software and related service to other operators of exchange and clearing and settlement solutions, and we already have clients with an existing market model that run on T+0. Funnily enough, a couple of them are actually looking to go to T+2 to be internationally compatible. So there are other dynamics. But I think what's interesting with the technology like a distributed ledger or a shared ledger or a blockchain is that it enables new business models that may offer new ways of organizing a market. We may have a different market model, different participants doing different things. I think that is the exciting part of it.
I think that's right, and I want to come on to the market model in a moment, but I'm just thinking about that. One thing that isn't going away is the regulatory obligations that is rightly, in many ways, on this marketplace. So unlike Bitcoin networks, where it's anonymous, a blockchain network for capital markets, everyone on that market must be identified, must be known, one presumes. I believe everyone agrees with that. So under that construct, I think that there's been a lot of conversation that there would be some competent authority who would be the key master or the validator who is going to be operating onto the capital markets perceived blockchain environment. Do you all agree with that? Do you see that as a potential future?
I'll say that I think, again, that the technology allows for breaking assumptions of what it means to have a strict and necessary regulatory environment and walled garden. You don't need to have the same sort of central control that you do today when the technology is different, because the technology enables a different kind of decentralization. It enables more of a peer-to-peer market. And so you can have the same sort of security and safety that regulation today provides in a new regulatory environment, which also protects customers and individuals and companies as it must. The regulation will have to change, but it isn't as simple as there's a master set of keys and a master set of validators. That's what changes. It's how the regulators operate, not what they do, but how they do it.
I think the nice thing, well, the good thing about technology is it's able to be developed by people to solve the problems that we all face. But the problem with the technology is it's designed by people, and it will eventually fail, as all technology does in some manner. So when the technology does fail, you have to have that body to complain to and that governing function. Because if the entire world is on autopilot, there are many movies that kind of show the demise of mankind that results from that. So I think the idea of a model that is a pure automated model without governance, everyone has seen in various ways how that plays out. So the idea of governance, I believe, is critical. Can the technology itself solve a lot of the problems and automate a lot of the problems around identity management and distribution of information and distribution of keys? Absolutely. And I think being able to go through the different iterations of experiments, proof of concepts, and production implementations that get us there in one phase at a time are critical to moving this forward.
I completely agree.
But so no automation by Cyberdyne systems for blockchain. You got that?
Exactly.
The network got smart.
Yeah, unintentionally. Yes, you absolutely need strict governance and oversight, and a party to effectively bring your grievances to when something goes wrong, because things will go wrong. I'm just saying that the models in which that occurs and which that makes sense have changed. When someone steals something from you today, from your phone, it's a different thing when someone steals something by breaking into your house. It's a different thing from stealing a horse 200 years ago. The fundamental model of how enforcement works and how regulation works has to change with the technology. I'll say that Symbiont has been very welcoming and forward-looking in talking to regulators about how best to regulate this new technology, which does absolutely need regulation, like any other.
Okay, so we're all agreed somehow that there needs to be a significant level of governance for all the regulatory aspects. You're thinking the regulators are going to change, which will be an interesting thing to see as it happens. I think that we're seeing largely a process issue in capital markets as opposed to a technological one. And we're seeing long settlement times that are perhaps causing unintentionally challenges in the market. There's a significantly restricted level of capital that's available in our marketplace due to regulatory fiats. The cost of operation in the financial services is unsustainable, and ROE is flat to declining because banks and brokers aren't able to leverage their balance sheets. So, Manuel, how do we get out of this? Does reduced settlement time release capital into the market and create a more efficient financial services fabric?
Yeah, I think in some aspects it depends on your business model, right? So I think what you're talking about, you're talking about ROE, and every bank, and ours is no different, has many different ways of earning money, whether it's fee-driven, transaction-driven, agency-focused, whatever it is. But it's all ROE at the end of the day. And I think what I tend to focus on, what Credit Suisse tends to focus on, is looking at the ROE equation, revenue minus costs, and we look at what blockchains can achieve for us in terms of cost savings. And actually, that's quite I don't say it's an easy thing to do, but it's something that we set out doing, and pricing out what are the functions we can automate using things like smart contracts. We did a project with Symbiont last year actually that helped us to do some of that kind of workflow. But then also, surprisingly, we're able to look at the capital side of it as well. So, looking at the capital, which is operational risk, credit risk, and market risk. Well, credit risk speaks to counterparty risk, which if you have 3-day settlement, 25-day settlement, 100-day settlement on distressed loans, and you bring it down to something that's more reasonable, you're reducing your credit risk, which means you're actually reducing your capital usage. Also, operational risk. We talk about reconciliations, and I think we sometimes forget what reconciliations do. They are this kind of the band-aid that helps us to mitigate operational risk. So if you remove reconciliation, you're actually reducing significantly operational risk. And that's what, if each of you working for different financial institutions, work out what the fines that your institution has received over the last 5 years, divide it, and that's what the government, that's what the regulators are charging you in terms of your capital for running this, and it's high, depending on which institution you're in.
So do we think that the other part of the question in reducing settlement times will release capital into the market? Because I think we've got a bit of an inverted triangle that's out there today, that capital is being reserved for banks' largest customers, and we're choking capital away from the rest of the market.
We're working on POCs that actually look at two of the POCs that we're working on actively are directly focused at reducing settlement times in order to free up capital. One's actually in equity, so despite what Rob was talking about, I think there is an opportunity for some of our clients, particularly the HFTs, who want to speed up. We'll allow it for them to speed up and free up capital. It frees up our capital too. And obviously we're a big loan shop, so we want to focus on helping to reduce loan settlement times. But yeah, absolutely, speed and settlement is critical to us.
You guys like to comment on this part of it at all?
I mean, I think there's a lot of aspects of loans in particular. To Emmanuel's earlier point of going up through from the sub-basement to the basement. The real value of the technology is not let's look at this technology and hammer every business problem with it. The near real-time information sharing among multiple parties that are involved in a transaction is really the fundamental value proposition, and you've got to say, what does that enable, and what kind of capital can that free up, what kind of efficiencies can that create. Just doing we're going to replace an existing system just to get some minuscule benefit is not what this is all about. This is about potentially fundamentally changing some business models that can be enabled by information sharing between multiple parties near simultaneously, and loans in many different asset classes fall into that category. From origination to a servicing, the whole loan could be on the chain. So then you have an asset thing, which is a loan, that is digitized from its entire life cycle.
Yeah, completely agree.
Yeah, and when you do that, when you add new business models, when you dematerialize the instruments into a new technological infrastructure, you, in addition to the cost savings and reduction of operational risk, you also add new revenue streams because of new financial instruments that can be created that work well in the new infrastructure that didn't work before.
Okay, so capital markets role in this as well. I think that we've seen a history of capital markets being the first digital industry out there and created in silos and proprietary things, and it seems that this time around we're trying to do so around standards. And Frederick, we've got multiple standards bodies that are out there trying to come up, it seems, with the same standards. What's the role of capital markets in driving standards for blockchain?
I mean, we have actually, NASDAQ has actually, our little contribution to this space has actually been to start the other way around. I mean, we have started with certificates and applications and tried to deploy them actually not so much getting in with support, but not so much getting engaged in some of these standardization discussions. I think ultimately interoperability or standardization, whatever you want to call it, is of course beneficial, but there will be competing approaches to that. I don't think there will be a chain to rule them all, but in order to not repeat some of the fragmentation that we've seen, it is of course helpful if we can see some kind of at least interoperability solutions. And it's good to see that there is quite a lot of brain power going into interoperability initiatives, and there seems to be a quite unusual sort of co-opetition approach by capital market participants to actually form, at least in a limited number of these initiatives. You have R3, you have some of these companies effectively consortia, you have Hyperledger, etc., that seem to embrace other initiatives. I think that's promising, but before standardization becomes a relevant point, we need to start to approach some kind of larger scale adoption of the technology for real market use, and we're quite far from that. to be honest, in my opinion.
Adam, Rob, I know your firms are involved in these conversations. Is it standing up individual use cases and getting them functional, taking a look at what standards come out for investment in the space as to where the technology is going? What are your views on that?
I mean, standards are hard, and anybody who's been in the standard business knows that just getting everyone to use the same version of anything, any standard, if we could have everyone use the same version of Oracle or MySQL, the same stored procedures, the same business structures, the same schemas, you wouldn't need you wouldn't need distributed ledger because everybody would be using the same thing. The real beauty of this technology is it kind of solves that standardization program, but the interesting thing is when you have multiple different versions of ledgers and you have multiple different fabrics emerging, you're basically creating a whole new set of reconciliation problems.
Yep.
And you're creating a whole new set of translation requirements. And you're really creating a whole new set of intermediaries that need to be involved, whether they're technology intermediaries or actual bodies that need to be translating at the different trust boundaries between the two. We think various layers of the fabric will eventually become standard. We believe they will eventually move towards open source because open source seems to win and seems to get the most traction. Whether it's going to be what the components that the Hyperledger project is working on today and the multiple firms that have contributed to it, or whether the big tent that is the Hyperledger project will invite some of the other initiatives that are going on in and they contribute and the Hyperledger project morphs into something larger. Eventually, all the pieces will connect, but it's the Big Bang formation of the distributed ledger universe, and there's let a million projects bloom.
So, Manuel, how are you seeing it from a bank perspective? Are you looking at specific initiatives, or that is beneficial to Credit Suisse, or are you thinking that this is something that has a larger impact overall to the bottom line of a global institution such as yourself?
Talking about standards or the projects themselves?
Either place you want to go.
So on the standards, I'll do both. On the standards piece, I think that maybe it's maybe more wishful thinking, more of a hope than anything else. I don't think there's going to be one chain to rule them all. I think there'll be several, but I don't think there'll be 500 either. And I think that, like what we see in the hardware space, a small number of leaders get in the room and they define the standard that everyone else follows. So that's not to dismiss the Hyperledger project, which has way more people and way more cooks than maybe is practical to herd. But I do think there's going to be a small number of companies that we all know who they are that will end up defining the roadmap for the next 2 years. That's maybe a hope. I'm not sure. In terms of at the bank, I think we started, certainly I did anyway, my initial thought was, coming off the learning about Bitcoin, it was easy to come into an environment where you thought, let's focus on things that, like loans, where we still fax and we still email and we still do all these really slow things. Let's focus on things that are low transaction numbers and low number of participants. But I think our thinking's evolved since then, and the POCs that we do demonstrate that. So, the previous panel, we were one of the 4 banks involved with Axoni's testing CDS along with DTCC. We've done some POCs with Symbiont on loans and continue to do that. So, I think we focus on areas that that are strategically important for the bank, and where we think the technology, more importantly, aligns itself to benefit us.
Okay, so I don't think that we're presuming that the capital markets is going to rip out their existing infrastructure.
Definitely not.
And replace it with blockchain, but to be able to obtain the benefits of blockchain, one presumes is going to be abstracted or layered on top. Do we see that happening for the more automated processes today as time moves on, going beyond the sort of greenfield views of trade processing that is entirely or close to entirely manual today? As we're moving past those phases, how would you gentlemen feel that blockchain might be leveraged to more mature, perhaps even more automated processes to have a synchronous whole?
I'll say that I think it's at least somewhat or largely going to replace a lot of antiquated manual workflows. And the reason is that it's a fundamentally different architecture from the centralized client-server architecture, traditional database architecture that we've had previously. And a lot of, some markets have gone over to centralized databases and have been digitized and dematerialized, but other markets haven't, and they've resisted stubbornly. And the reason they have is that it's not the right architecture for those markets. And when you have a different kind of architecture, that it will be able to do things that the previous architectures haven't. You take a slow, decentralized, illiquid market, and you try and put it on, in a central limit order book. You're going to have problems, and it's just not going to work because you don't get the same benefits that you would moving equities to it. And when you and yet it's much easier to move such markets over to distributed ledger architectures because they fit that model better.
The fascinating thing to me is that we even this conference and the symposium that DTCC held, there's a lot of focus right now on plumbing because the financial industry is really all about plumbing. But I look at my son who's in college, and he doesn't know the financial infrastructure. He doesn't know DTCC. He doesn't know a broker. He doesn't have a broker. He knows Venmo. And he pays his friends in Venmo, and after dinner they all Venmo each other, to split up the bill. And it's all about the user experience. And this new generation that's coming in, they're mobile. They're not beholden to any of the constructs that have been built over the last 40 years. So we're in the middle of the plumbing weeds and figuring out the plumbing. And there's going to be some killer app that comes out that redefines the market for all of us and creates that Uber moment we're all looking for. It's not going to come out of the plumbing. It's going to come out of the user experience. And I think we're going to all learn and react to that.
Yeah, sure. I think generation now is a virtualized experience of life, but capital markets, the market makers, have owned all the plumbing to their advantage for the entirety of the markets. So we're not suggesting that it's going to be virtualized in some way, and capital markets is just going to be little virtual nodes on the network. Emmanuel, do you see it going that way? I imagine Credit Suisse might have an opinion.
I don't see it going that way. I see the focus on what you should be getting paid for. Alpha should be paid for providing your clients with best-in-class services, advice, best-in-class research, and not getting paid for the plumbing. The plumbing is a necessary part of what we do.
Sure.
So that's really it.
And Frederick, as a service provider, it's plumbing, but I just moved into a house last week. I've had plumbers in my house all week, and funny enough, my boy's going to go into plumbing and heating, I've decided. So plumbing's not cheap, though, is it?
Plumbing is important, and it is easy to imagine what the world could look like quickly if you start from a blank sheet of paper as well. But we don't start from a blank sheet of paper. We don't start from a legal or regulatory blank sheet of paper. We don't start from a sort of blank history. We don't start with a blank piece of infrastructure to support those processes and laws and regulations that we have. And then integration, as you brought up, becomes absolutely critical for the wider scale adoption of this technology. And that transition plan, or what does that transition look like? Because there needs to be a credible story for how it's going to happen, and there needs to be an end to the old history. Because we need to convince capital markets that they'll be able to decommission swathes of systems and reduce operating costs. Because if they don't believe in the story of that happening, they're not going to invest in the transition, which is required for this technology to get large-scale adoption. So I think that is going to be absolutely critical to the wide-scale implementation of ledger technology, that there is a credible transition plan that people can buy into.
I think just building on that, it's not just a credible, you're absolutely right. I think the IT profession has to also convince the business guys. I forget who said it, I think it was yesterday, talking about ERP, and that was just early this morning. I think we've had so many false dawns from an IT perspective in the banks where we promised, alchemy and delivered lead. And I think we have to we have to be careful this time. I think there's less money in the system Our business leaders are less inclined to just write a check and see see how it goes, doing a Hail Mary, and we are having to. I find myself spending a lot more time validating the technology, validating the assumptions, talking about the integration and the difficulty and the challenge around it. The last thing anybody wants is to end up with a blockchain system and the old legacy, because now you just doubled their costs. So that's what's really, really important.
So that's perhaps why we're seeing then the industry taking a look at individual science experiments in places where clear efficiencies can be gained. So we're looking at a much longer timeline perhaps than I think that some of the hype, if you will.
I'd say, hogging the question, I think one thing I notice about my business users is the guys that are in the seats today are far more tech savvy than they were 15 years ago.
Sure.
So 15 years ago, they were absolutely just focused on best price and trading and et cetera, et cetera. And technology was leave it, you're the guy, leave it. And now, the head of fixed income or the head of FX is a mathematician. He knows computer science. It's a different conversation you're having with him.
Well, it's enabling and annoying at the same time.
It is annoying. It is very annoying.
There's an aspect of the financial calculation that's still enigmatic, and I think that's still evolving because we've looked at a number of different use cases, and a lot of the use cases and a lot of the comparisons and a lot of the cost conversations are around the existing formulas, and we've looked at a number of cases, started evaluating a potential distributed ledger solution, and it turns out that a simple MySQL database on the cloud is good enough. And that solves the problem at a fraction of the cost of the existing solution, and without any of the, questions and complexity that a nascent technology brings to the equation. So I think, the math formula needs to be applied, but it needs to be stuff that's measurable, and right now it's a little bit challenging to measure what that end state formula is going to be for a distributed ledger.
So this is all summing up that there's going to be, as we're saying, multiple point cases, multiple chains that are going to be created, and then integration at some point in time is again going to become a massive problem within financial services. And who then, I'm just wondering, I've heard folks talk much about this, who owns the data then on the blockchain? So right now, for some of the things it's supposed to be public, some of the more opaque markets, the market participants are owning the data. Who winds up owning the data?
I'm not a lawyer.
No?
Yeah, I think I'll extend that question because there's a lot of conversation we're going on now with a lot of our vendor partners on the intellectual property and where the line is between what is industry knowledge, repo for instance, what is the secret sauce of a particular firm, and what vendors can claim as intellectual property of the ledger, because it's not as simple as the old days where you had a database and a schema and stored procedures for business logic where the business owned its piece. It's all kind of mushed together in this distributed ledger, so that IP conversation has been very challenging.
Yeah, I think adding to that, there's a complexity around data protection. I know there's different models of databases out there or different implementations of blockchain, but do I have to tell my customer that their record may end up in databases around the world, and what's the impact to me of doing that? What's my 7-year protection now on trade history? There are lots of questions that need to be answered. We don't have the answers for them.
Right. So that comes back again. What's the governance and the environment? Again, perhaps it's a poor phrase around walled garden, around what happens with the PII, with the personal information that's there, with the trade records, with things like consolidated audit trail coming. Does that then automatically, if it ever gets there, we're not saying it's happening for flow markets right away, but regulators, well, let me ask you this way. I'm sure you've all been having conversations with regulators. Would you like to give us a color of what you think the regulators are doing? Are they drooling with excitement and having real-time view of everything that's immutable? Or are they taking a watching brief for now to come around? Frederick,
no, we do have a lot of discussions with both legislators and regulators because and there is a mix of drooling and let's see what happens. But I think I think we as an industry or community in this space have sort of gone out there and say, sort of gently, don't overregulate. And we like when commissioners of the CFTC say, let's do no harm and take that approach to it. I think we need to be a little bit more nuanced though, and also say, that's fine, that's helpful. But actually, for some of these promises to become true, you actually need to help us. There needs to be legal certainty. Some of these business models that are now being contemplated based on a new technology, they are not anticipated by existing legislation and regulation. And there we actually need to work with, I guess, in the beginning, legislators and then ultimately regulators to help create that legal certainty. And that is a varying landscape over the globe. I mean, in some countries, it specifically says, a publicly listed share has to be registered in the CSD. Well, a peer-to-peer model is simply illegal. What about settlement finality, data privacy we've been touching on? So it's not only about don't regulate too hard, it's actually also about, well, we need to work together to pave the way for some of these benefits for the market, but also for the regulators at the previous panel discussed about transparency and insight into what is going on for the benefit of mankind. I think those are the kind of discussions we are having with these guys.
Just to add to that, everything that Frederick says is absolutely spot on. Just to add to that, one of the things that when I've spoken to our public policy and regulator groups is, when we make assumptions about what the technology is going to do for us in terms of helping reduce capital, but only they will tell us how they'll actually treat it. So helping to have that and shape that discussion today. I think in the UK they have their regulatory sandbox, which is where we can go and put the technology in place and ask those kinds of questions. But we need all the different regulators to have that kind of foresight and provide us with those tools, so we can get those answers.
So that perhaps really is the real challenge here for capital markets. This isn't necessarily a technological equation.
Right.
It's a technological equation, a regulatory equation, a business preference equation, a changing market dynamic. The market is more of an agency model now today, since the balance sheets have been taken away from everyone. And there's some folks running around and saying, well, if that's the case, if it's simply an agency model, why don't we just go ahead and move to peer-to-peer? And people jump up and say, well, blockchain is going to give us the ability to settle peer-to-peer. The real market, the buy side, is just going to execute with each other. Why is that a problem?
Maybe that's the way that we evolved to. I don't think we're going to get there overnight, but like I said, there's a basement filling up with water, and you've got to decide which floor you're going to rest in and stake a claim to and drive value out of.
Well, so on that view, I mean, there's just so many drivers in capital markets that are coming together simultaneously, perhaps, or perhaps it would be better if they did come together simultaneously. It seems to be somewhat sequential. No one's really heard from the regulatory authorities, and does anyone think that the regulators are going to have some epiphany of convergence on how any of this is treated?
I don't know what it looked like 200 years or whenever the buttonwood tree existed, or I don't think they were buy side and street side referred to back then.
Yep.
Certainly there weren't CCPs and CSDs. So I don't think anyone would say the current market structure was designed and intended from an architectural perspective. And I think we just have to see how it evolves and where the right new efficiencies are and what the right new governance structures are, because they will certainly change. But it has to be an orderly, controlled, risk-averse migration, because when we start talking about people putting real money, their retirement accounts, their 401ks, and their insurance policies on this technology, which in most respects does not exist today, there has to be somebody watching the pot of gold.
Sure. So Adam, it sounds like ultimately it's all going to come down to integration and flexibility of the technological stack.
Yeah, the technological stack is very powerful and breaks a lot of assumptions. I'll say on the regulator front that it was announced yesterday that Symbiont has partnered with the state of Delaware to bring blockchains and distributed ledgers to the creation and management certification of private equity, and they've been incredibly welcoming and knowledgeable and very helpful, and it's been really a pleasure to work with them, and they've taken a very forward-thinking approach. to the technology and seeing how the introduction of it can massively benefit companies that are registered in Delaware.
All right, well, I think we're at a point still where there's perhaps more questions than answers, and at least there's a tremendous amount of brain power and a significant amount of investment being applied to the space. So that's our time. Ladies and gentlemen, please join me in thanking the panel.